Right, I think we're all good to go. So good morning, everybody, and welcome to December's Live and Learn session, where today Vicky's going to take us through the chart of accounts and why they are so important. This is in follow-up from Vicky's blog that went live, I think last week or the week before, that Maddie shared around with everybody. We just wanted you to understand what we kind of do a little bit behind the scenes. It kind of makes a little bit more sense to you, and how things are made up and everything. So I'm going to hand over to Vicky, who's going to give you a little demo of what's what and where you can find it. If there's any questions, please feel free to pop them in the chat box, or if you're watching on Facebook, pop them in the comments and I will get Facebook up on my laptop, my MacBook, iPad even, get there eventually, and we'll be able to answer those as well. Or for anyone watching the recording, if you either drop the messages to us on the email or in the group, we can answer them afterwards. So yeah, I'll hand over to our Vicky.
Hello, thanks Cheryl. Okay, so I'm Vicky. Some of you already know me as I do the year-end accounts for Pink Pig. So when the accounts are handed over to me from the guys at Pink Pig, the first thing I do is check that all transactions have gone to the right place. Now, whether Pink Pig do your bookkeeping or yourselves, where things go is very important, where you code your purchases, your sales, etc. But what determines where things go? So this is the chart of accounts, it's called. It sits behind zero. You all have access to be able to see it, so I'm going to show you where. So what is a chart of accounts? So in the main dashboard of your zero, if you go to accounting, and then right there at the bottom, you will see under advanced chart of accounts. I'm within the demo company at the moment, so this may have a few slightly different things, but mostly this is the standard chart of accounts that Xero has. Now we can add, we can change, we can mess around with this to tweak it specifically for your company to help you, but this is the main basic chart of accounts that Xero has. So this is an index basically of all of the financial accounts that will make up your financial statements. Now, your financial statements is your balance sheet and your profit and loss account, which make up your statutory accounts at year end. So by separating out into all of these categories, this gives you an insight into where your business is, what its liabilities are, what its assets are, and obviously what its profit is, and ultimately if there's any tax to pay. So as you can see here, Xero breaks them down into type. Now there are 5 main types that they break it down into: revenue, expenses, assets, liabilities, and equity. So if we start with the first one here, this is revenue. So this is all your sales. So any sales within your company. So any main revenue goes under here under sales, other revenue, and interest income. Now, Xero only put 3 up here, but again, if you want to break down your revenue, if you have different streams where your revenue comes from, then we can break this down further for you. But yeah, this is where your main revenue comes from, so all your sales. Then it moves into your expenses. So you have your direct costs here, your overheads. Now, if we start with the direct costs, these ones here, direct costs are costs that directly relate to your business trade and therefore will fluctuate with the quantity of sales that you have. So, for example, if you build wooden tables, then a direct expense would be the wood, the screws, any subcontractor that you may use to help you, any carriage that then is to post it out, or courier, for example, or delivery company. It's a direct cost. So without that cost, you wouldn't generate any sales. Then you go into the expenses, so the overheads here. Now, overheads are costs that occur no matter what the volume of sales are. So if you rent a unit, if you sell £1 or £1,000, your rent is going to remain the same. Your broadband line coming in, again, doesn't matter what your sales are, your broadband is a fixed cost. So overheads are costs that occur no matter what your sales are, be them £1 or be them £1 million. So they all, again, are categorised down here. Now, there's lots of them, the light, power, heat, motor vehicles, printing and stationery. You may not use all of them. You may wish some to be renamed, but these are the ones, again, that are the standard ones within zero. So if you would like any extras added, or if you would like any renamed so that you know a little bit more what they mean, then give us a shout and we can do them for you. And then expense. Now, as far as zero is concerned, it treats expenses and overheads in exactly the same way. So when it comes to the difference between a direct cost and an overhead, to give you an idea in the account, so you'd have the revenue, then you have your cost of sales, so your direct costs, and then underneath you have your gross profit. So it's your revenue less your direct costs becomes your gross profit. After that, all your overheads come off, and that's what then becomes at the bottom, your net profit. That's why it's important where it goes, as in direct cost or overhead, because it's basically above or below the gross profit line. Then you come into your assets. So you have different assets. We have current assets, fixed assets, and then your inventory. So if I start with an easy one, inventory is exactly what it says. Inventory is your stock. So again, depending on what your company does, if it does, let's go back to my tables example, as I might as well follow through with the same one. If you've purchased a whole load of wood during the year, and at year end you still have some left over, that will have a value, and that is an asset to the company, is your wood that's left over. So that would be your inventory. After that, we move into current assets. Now, current assets are, again, assets to the company, but these are going to be sold or used within a year. So the most common ones that goes into this is like your accounts receivable. So people who owe you money. Obviously, we all hope that anybody at year end who owes you any money, it is going to be paid within the year. This is just a lag over from a year. So if your year end is the 31st of December, if you've invoiced people out in December and they're not going to pay you till January, then that's called a current asset, because it's at year end, it's a debt to the company and it's an asset. The fixed assets, now these are slightly larger pieces of assets. So for example, any equipment that you've purchased during the year, any computer equipment, laptops, for example, any vehicles, vans, anything like that. Anything that's, we tend to say, around over £100 and is going to be used in the company to generate sales for longer than 12 months. So again, like if you've purchased a vehicle, then you'd expect the lifespan of the vehicle within the company to be 3 years. So that would be a fixed asset within the company for 3 years. So that falls into here. And then you have the depreciation accounts, which we deal with at year end for you. After that, the other asset that tends to sit there is a prepayment. A prepayment is, so for example, if you have your rates bill up front and you pay for it all up front, and the year of the rates is April to March, but your year is January to December, then there's 3 months there that you've paid up front for the following financial year. Therefore, that's classed as an asset. You've paid 3 months up front to pay for your rates, and that falls into a current asset as well. After that, we go into the liabilities. Now, again, you have current liabilities and non-current liabilities. So here we have all the current liabilities. So these are, again, similar to the current assets. These are liabilities within the company that you expect to be settled, i.e. paid off within a year. So again, the most common one in here would be your accounts payable. So if you'd had invoices all in from suppliers in December and you're going to pay them in January, but your year end on the 31st of December, there will be a debt to the company for those suppliers. Therefore, it's a current liability. You'd expect to pay that off within the year. Credit card is another one that goes in here. So your December credit card bill is outstanding on the 31st of December, but the direct debit comes out on the 15th of January. That credit card is a debt to the company at its year end, but it's a current one because it will be within the year that it's paid off. Again, so your national insurance, your corporation tax, all of those accounts, your VAT, they all sit within a current liability because they'll be paid off within 12 months. Then you move into the non-current liabilities. So these will be things like mortgages, loans. The most common one at the moment is the bounce back loan. These sit within the non-current liability. These are liabilities that are longer term than 12 months. If you had a loan, for example, for 5 years, at year end, the first 12 months of that loan sits in the current liability as it's under 12 months, and then the remaining 4 years goes to the non-current as it's now going into a longer term than 12 months. Finally, you have equity. So equity is the amount of capital within your company. So you have your main one, which is your shares. So when you first set up the company, however many shares that you issued at the time, be it 1, 100, 1,000, then that sits in your share capital. Retained earnings are any profit that you've carried forward from the previous years, that sits in there. And that makes up basically how much you've got capital within your company that's yours. So the main reason that it's important that transactions are posted into the correct account is the first 2 categories that we spoke about, which is revenue and the revenue accounts here, and then all the expenses, which is the overheads, etc. They all make up the profit and loss account. So anything that's posted to those 2 types, they go into your P&L. So that makes up your everyday income and expenditure, which at the end of 12 months makes up your profit and loss account and determines how much profit the company has made at year end. All the ones underneath that we were just talking about, which are your current assets, your fixed assets, your current liabilities, your non-current liabilities, and your equity, that all goes into the balance sheet of the statutory accounts. So that is showing at year end what the company owes, is owed, and what the owner themselves have within the company. So if you post something incorrectly, so for an example, an expense goes to an asset account, then it will be in the wrong place on the statutory accounts and therefore will have an impact on your corporation tax at year end, because things that are in the balance sheet have no impact on your corporation tax. It's only things that are posted into the profit and loss account that have the impact. Like I say, at year end, one of the main things I do is go through and check through all the accounts and make sure what I think should be an expense and what should be an overhead or what should be an asset are in the correct places and move things around if necessary. But this is just to give you the reasoning why behind what is done and what we do, because of the impact it has on corporation tax and the value to your company, because a balance sheet at year end is obviously telling you what your company's value is worth or its debts are worth, etc. So that's my main explanation of the chart of accounts. If anyone has any questions, or Cheryl, you may have something to add.
Yeah, no, I was going to say that's really good. Thank you, Vikki. And I guess not only the profit and loss doesn't also affect just tax, it also affects your dividends as well, doesn't it?
Ah, yes, it does. Yes, because if you've understated if you overstate obviously your profit, that has a big tax impact. But if you've understated it and you require dividends, obviously, yeah, that can have quite an impact on whether you can take the dividends required for the year. Yeah.
Yeah, nice. So, yeah, really, really important. And also just wanted to add in as well, there's some CAS codes. So if you are a CIS business, we can add in the CAS codes, and Xero uses these to then produce your CIS returns to HMRC as well. So that's why there are different codes for CIS labour and income, and opposed to non-CIS, so that the Xero can then use those to make sure that the right stuff's being reported in the CIS returns. So yeah, there's a lot of technical stuff behind it, isn't there, that we do and we check for. Obviously we check for, we never just assume that they're all in the right place, but we just wanted you to understand a little bit more about what we do really and how things are affected. So
may I put a caveat in that as much as you can add accounts, and if you do your own bookkeeping, you can, you know, add accounts into the chart of accounts. Please always just ask us, because if you do add it into the wrong place, it will have quite an impact on it. So yeah, happy to talk to people to tweak chart of accounts so that it fits them. But yeah, always please just give us a quick email or a phone call, and we will always help you set up any that you need. As much as you might try and freestyle it, it can cause some problems later on.
It can do. And I'm currently talking with the guys at Xero. I had a call with them last week, the team in New Zealand who are actually working on reporting and things, because what we've noticed is the corporation tax code is set as an expense in the chart of accounts, and all the expense types, or all the different types of expense and incoming and outgoing, they all drive then the reporting. So because it's set as an expense, it comes in with all the admin expenses, your overheads, so it's not giving the clear picture. So we are working,
a false expense, isn't it?
Exactly. So we are working with Xero at the moment, trying to find the best workaround for you on showing you how to get that report. But I have a horrible feeling it's going to be a job for myself and the team to custom you a report that you can use in every single subscription. So bear with us on that one. As I said, we are dealing with it. So I think the other thing I wanted to just ask Vikki is, what are the main things that you see where they go to the wrong one? So
the main ones, I have to say, are between the asset accounts and the expense. Mostly, for example, motor vehicle seems to be quite a big one. People will post fuel to motor vehicles. Now, motor vehicles is a fixed asset account. So that is basically anything much bigger than your fuel. So it needs to be more a car or a van or a trailer example. If it is fuel, it doesn't go to motor vehicle, it goes into either travel expense, or again, we can rename one for you that is literally, you know, fuel, or there is one there that's motor vehicle expenses. So the biggest thing I see is, or if you purchase, for example, a cable or something like that, then people will put it to computer equipment. Yes, I understand why, because it is a piece of a computer equipment, but it's a £5 lead. It needs to go to the IT software and consumables. So it's written off in 1 year. If it goes to computer equipment, then obviously it looks like you're trying to make that a fixed asset. And it isn't for £5. They're the main ones I see, is mostly computer and motor. But yeah, it's, again, we obviously always pick it up at year end, but if you're reporting, if you're wanting to run profit and losses for yourself just to have a look at monthly, then our profit will look quite different to you at year end, because we've moved a load of transactions around, and you may wonder, hang on a minute, I had 20,000 profit, but because I've gone and picked a whole load of stuff out of an asset account and dumped it into an expense account where it should be, suddenly I could have decreased your profit by £5,000, which again will have a knock-on effect to what dividends you can take. So yeah, they're the main ones I would say, is the computer equipment and motor, fuel and motor vehicles, etc.
Yeah, okay, cool. And I've completely lost my train of thought. I was actually just going to ask you another question, and I've completely forgotten my own question. So that's really, really helpful. I guess, oh yeah, that's what I was going to say. We have put together, and I think I've circulated it before, but for those who do their own bookkeeping, we do have a like a cheat sheet of Xero of what goes where. So when I send out the recording, I will send a copy of that again with it, just so you've got it for easy reference, because I know what it's like. You get all these guides and you pop them in a safe place, never to find again. So I shall send that out, and it's also in the blog as well. There is a link in the blog to download it. Yeah, so I can't see any questions coming through. Does anybody have any questions? No, can't see anyone. As I said before, if there are questions for those, I can't see any on Facebook either, but my internet's playing up this morning great pun. So there could be something wrong there. So if anyone does have any questions, then please feel free to comment on either the recording on the group or on another post on the group, or just drop us an email. We're always happy to help. So yeah, thank you for everybody watching this. Huge thank you to Vikki for sharing with us today. That's been really helpful, I'm sure, to many people, so thank you. Yeah, I shall say thank you very much, and I hope everybody has a fabulous day.
Thank you.
Bye.
Bye.